If you're an investor or intend to become one, you will of course want to know whether the company you're investing in is putting your investment to good use. But what measure can we use to determine this? Welcome back to the Industry Portal's Finance Explainer series, where learning finance is made simple. In this video, we're tackling a key concept that every investor and business owner needs to know: return on equity, or ROE for short. By the end of this video, you'll know exactly what ROE is, how to calculate it, and why it's one of the most important tools for evaluating a company's performance. So let's dive in. So what exactly is return on equity? Well, ROE is a measure of how efficiently a company is using its shareholders' money to generate profits. In simple terms, it tells you how much profit a company makes for every pound of equity invested by its shareholders. So think of it like this. If you invest £1 in a company, ROE tells you how much profit that £1 generates. Is it 5p, 10p, maybe 20p? The higher the ROE, the better a company is at turning shareholder investment into profit. Now, the formula for ROE is as follows. ROE equals net income divided by shareholders' equity, where net income is the company's profit after all expenses, taxes, and costs, and shareholders' equity is the money shareholders have invested in the business, including any retained earnings. The result is expressed as a percentage. So let's break this down with a simple example. Imagine there are two companies. Company A makes $10,000 in profit and has $100,000 in shareholders' equity. Company B also makes $10,000 in profit, but it only has $50,000 in shareholders' equity. Now, if we calculate the ROE for both companies, Company A would equal 10,000 divided by 100,000, which is 10% ROE, whereas Company B would be 10,000 divided by 50,000, which is 20% ROE. So what does this tell us? Well, even though both companies made the same profit, Company B is generating more profit for every pound of shareholder investment. A higher ROE usually means the company is more efficient and better at delivering value to its investors. Now, you might be wondering, why is ROE so important? Well, here's why. Firstly, it measures profitability. ROE is one of the best indicators of how well a company is managing its resources to create profits. It's especially useful for comparing companies in the same industry. Secondly, it shows management efficiency. A high ROE often means the company's management is using shareholders' funds effectively to grow the business. And thirdly, it helps investors make decisions. If you're investing in stocks, looking at ROE can help you spot companies that consistently deliver strong returns on equity, which may make them better for long-term investments. But here's something important to keep in mind. A high ROE isn't always good. Confused? Bear with me. Sometimes a company might have a high ROE because it's using a lot of debt to boost returns. Now, while this can make the ROE look great, it also adds risk. So here's an example to explain that. Imagine two companies again. Company X has no debt and a steady ROE of 15%. Company Y has taken on a lot of loans, so it has a high ROE of 30%. Now, while Company Y's ROE looks better on paper, that high return is being driven by borrowed money. So if things go wrong, like a downturn in the economy, Company Y might struggle to pay back its loans, making it a much riskier investment. So when analysing ROE, always check the company's debt levels. Look at the debt to equity ratio to see how much leverage the company is using. Also, look for consistency. Is the ROE steady over time, or is it all over the place? Consistent ROE is a sign of a strong, stable business. And analyse the industry standards. ROE varies by industry, so always compare companies within the same sector. So let's do a quick recap. Return on equity, or ROE for short, measures how much profit a company generates for every pound of shareholder equity. A higher ROE means the company is more efficient at using investors' money to make profits. Always check for debt levels and compare ROE to similar companies in the same industry to get the full picture. And that's it. Return on equity explained simply. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about finance, be sure to check out theindustryportal.com, link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.